Accrued expenses and accounts payable are both accounting terms for money your business owes that needs to be paid in the future. Both accrued expenses and accounts payable are current liabilities that appear in the same section of the balance sheet and are expected to be paid for within the next 12 months. But while they appear to be the same thing, there are some differences. Let's say you're reviewing the latest balance sheet for your business, and it contains these items in the current liabilities section: accounts payable, $10,000, accrued expenses, $3,000, and wages payable, $20,000. You're a little unsure as to why there are so many different current liabilities and what they all mean, so you sit down with your business's accountant, who is more than happy to explain. She starts off by telling you that the $10,000 of accounts payable is the total amount of unpaid supplier bills currently entered into the accounting system. When you receive goods or services from certain suppliers, they send you a bill that usually gives you 30 to 90 days to pay, so it's normal for there to be some unpaid bills on the system at any given time. She also tells you that suppliers are sometimes referred to as creditors, and that's why accounts payable is sometimes called trade creditors on the balance sheet. Not only that, she explains, when you enter a bill into your accounting system, the amount of the bill is also included as an expense on the income statement. So even though you haven't paid the bill yet, the money you owe is included in accounts payable on the balance sheet and as an expense on the income statement. By doing this, the expense is included on the income statement in the period in which it is incurred, instead of the period in which the bill is paid. This ensures that the business's accounts comply with the rules and regulations of accrual accounting. Happy with that explanation, you then turn your attention to accrued expenses. You'd like to know what it is and how it's different from accounts payable. Your accountant starts by telling you that they are fairly similar to each other because they are both liabilities that represent goods or services you have consumed but haven't paid for yet. And another similarity is that the expense is included on the income statement in the period in which it is incurred, instead of the period in which your business pays for the goods or services received. The big difference between the two, she explains, is that there are no bills in the accounting system for the items included in accrued expenses. You're a little confused by that because you wonder how an unpaid expense can appear on the balance sheet or income statement without entering a bill into the accounting system. Your accountant goes on to explain that there are a few ways this can happen. She decides to start with wages payable. Every month we do a pay run to our employees for the hours they worked the month before. For last month, after we finished entering everybody's timesheets into our accounting system, we could see that the total amount of wages we owed our staff was $20,000. The system then automatically posted a journal that increased the wages payable liability on the balance sheet by $20,000 and increased the wages expense account on the income statement by the same amount. That's why the current balance sheet shows a wages payable liability of $20,000, and it will stay there until we actually pay the money to our staff. So as you can see, to create this liability on the balance sheet, we didn't have to enter a bill into the accounting system. You think that makes perfect sense, and you're starting to understand how these liabilities work. But just to be sure, you ask your accountant if the $3,000 of accrued expenses on the balance sheet is made up of other costs you need to pay for that don't need a bill. Your accountant tells you that you're on the right track, but there is a twist. The $3,000 of accrued expenses is made up of electricity consumed by the business over the last 2 months that has not yet been paid for. The business gets quarterly electricity bills, but to comply with the rules and regulations of accrual accounting, we need to include an estimate of the cost each month in our accounts, and we do this by posting manual journals. So for the last 2 months, we've entered journals of $1,500 each month to include the estimated costs in accrued revenue on the balance sheet and in the electricity expense line on the income statement. By doing this, the expenses are included on the income statement in the period in which they are incurred and not when they are paid. Later on, we'll get a bill from the electricity company to charge us for the electricity we consumed for the entire quarter. Let's say the bill is for $5,000. When we enter it into our accounting system, it will automatically include the $5,000 in accounts payable on the balance sheet and the electricity expense line on the income statement. At that point, $3,000 of the expense will be double counted in our system and on our reports. To fix this problem, we'll post another journal in the current period. This journal will effectively reverse the original journals and will remove the $3,000 out of the accrued expense liability on the balance sheet and out of the electricity expense line on the income statement in the current period. The result will be that the $3,000 of accrued expenses will be gone from the balance sheet, and it will be replaced by an extra $5,000 in accounts payable. And the $5,000 will remain in accounts payable until we pay the bill. On the income statement, the $5,000 will only be included once, and it will be spread out between the periods in which the expense was incurred and not when the bill was paid. So in a nutshell, your accountant explains, accrued expenses is made up of costs your business has incurred for which we have not yet received a bill, while accounts payable is made up of bills that are currently unpaid. After such a great explanation, you now feel like you know the main differences between accrued expenses and accounts payable, and you have a much better understanding of your business's balance sheet.